Why am I so drawn to cover call ETFs? Let's break it down to 3 core reasons. First, they're fascinating. I know that sounds odd, but hear me out. My brother-in-law is a Bitcoin genius who speaks at conferences, and he's always pushing me to jump in. But Bitcoin doesn't spark my curiosity. I'm just not interested. If I followed someone else's advice, like dumping money into a plain S&P 500 ETF, I might not have developed the same passion for learning about finance. Cover call ETFs, with their high yields and unique mechanics, hooked me. They pushed me to dig deeper, ask questions, and understand why high yields aren't always dangerous, as critics claim. This is not financial advice and is for entertainment purposes only. Investors, welcome back to the channel. Today, I'm thrilled to share my journey as a cover call ETF investor, diving deep into my strategy portfolio and why I'm so passionate about passive income through these unique funds. I'm Jordan, a 35-year-old Red Seal plumber from a suburb of Vancouver, Canada, and I'm on a mission to achieve financial independence by 45. With a portfolio of just over $360,000 verified by Blossom, I'm earning just under $5,000 a month, or about $60,000 a year, in distributions from cover call ETFs. You can check out my portfolio, along with our hosts, on Blossom via the link in the description and pinned comment. It's free to view. Let's break down how I got here, why I love index-based cover call ETFs, my thoughts on high-yield funds like YieldMax, and some tips for beginners. Buckle up, because this is going to be a packed ride. My journey to cover call ETFs. Let me start with a bit about myself. I'm not your typical finance guy. I'm a ticketed plumber with a Red Seal, which lets me work across Canada. I build Navy and Coast Guard vessels for the Canadian government at a shipyard, working alongside a mentor who's been a game changer for me. This guy has a multi-million-dollar portfolio, owns real estate across Canada and the US, yet still shows up to work as a pipe fitter. About 4 years ago, just before I turned 31, he pulled me aside and said, "Jordan, do you know what a dividend is? You've got to get investing." I brushed it off at first. Those red and green squiggly lines on news tickers looked like chaos, not for me. But his words stuck, and he handed me a copy of The Intelligent Investor by Benjamin Graham. Let me tell you, that book felt like a textbook. I read it in 3 weeks, circling benchmarks, quotes, and formulas, barely understanding half of it. But it sparked something, a hunger to learn about valuing companies and building wealth. I started with Canadian dividend-paying stocks, a common entry point for Canadian investors. About a year in, I stumbled across cover call ETFs. At first, I was skeptical. High yields sounded risky, like those warning signs you hear about exotic investments. But the more I read, the more intrigued I became. One name kept popping up, Nick LaForge, a lesser-known investor who was my gateway drug into cover call ETFs. He owned XYLD, a US-based S&P 500 cover call ETF, and I followed suit, buying my first shares. It wasn't just about the yields. It was the idea of a hands-off strategy that fit my busy life. I'm married with 3 kids, working full-time with overtime, and juggling dishes and dad duties right before this video. I needed a portfolio that didn't demand constant attention. Cover call ETFs, especially index-based ones, became my answer. Over the past few years, I've contributed $1,000 a month, plus any extra cash I could scrape together, building my portfolio to $360,000 with nearly $60,000 a year in distributions. I post weekly updates on Blossom, 90 weeks of posts, so people can see performance, distributions, and growth side by side with the index. It gave me accountability and a record to look back on, which was huge for learning and refining my strategy. Why cover call ETFs? They're hands-off. With a full-time job, 3 kids, and a single-income household, I don't have time to micromanage investments. Cover call ETFs, especially those tied to indexes like the S&P 500 or NASDAQ 100, let me stay passive while still participating in market growth. These funds hold a basket of stocks and sell call options against them to generate monthly or weekly income. For Canadians, I stick to funds like those equivalent to QQQI, SPII, JEPIQ, GPIQ, GPIX, or TSPI in the US, which track broad indexes. This approach aligns with my belief that the economy will grow over time, and I don't need to pick individual winners. Third, the distributions are a game changer. My goal is to replace my paycheck bit by bit with passive income. Cover call ETFs are like tearing pieces off my paycheck and moving them into a portfolio that pays me back. With $5,000 a month in distributions, I'm chipping away at my reliance on my job, building toward financial independence. Plus, sharing this journey on YouTube and Blossom, where I've posted weekly updates for 90 weeks, lets me connect with others, showing the highs and lows of this strategy transparently. My portfolio's up over 20% on Blossom, not counting distributions, and those have grown month over month, defying the odds for a cover call portfolio. That combination convinced me cover call ETFs were worth deeper study. My portfolio, index-based and proud. Let's dive into my portfolio. It's 100% ETFs, no single stocks. Why? Researching individual companies, digging into income statements, balance sheets, cash flow, Graham ratios, or Tweed factors is too time-intensive for me. As Warren Buffett says, you need to stay within your circle of competence, and single stocks aren't in mine. I don't have the hours to analyze a company's operations or competitive edge, but I do understand the power of a diversified basket of stocks like an S&P 500 or NASDAQ 100 ETF that benefits from macroeconomic growth. My portfolio is mostly index-based cover call ETFs, tracking broad markets like the S&P 500 or NASDAQ 100. These funds hold hundreds of stocks and sell call options to generate income, typically yielding 10 to 16%. I also have some sector-focused ETFs, not tied to a single index, that boost my yield to 16.42%, as verified by Blossom. This is one of the lowest yields in the cover call space, which sounds funny because 16% is high compared to traditional dividends. A bold move I made was selling my condo to upgrade to a townhouse rental, funneling the proceeds into my portfolio. It's a calculated bet on cover call ETFs as a sustainable long-term strategy. My portfolio's at all-time highs, even after events like Liberation Day's correction, because I'm spread across the economy. If one sector dips, like my small energy position, others pick up the slack. This diversification, combined with reinvesting distributions, keeps my portfolio growing steadily. Why index-based over single-stock ETFs? You might be wondering why I stick to index-based ETFs instead of single-stock cover call ETFs like MSTY, NVDY, PELI, or HUI, which can post 100% plus gains. Don't I feel like I'm missing out? Honestly, no. My strategy is built around my life and goals. With a busy schedule, I need investments that don't require constant tinkering. Index-based ETFs track the broader economy, which I believe will grow long-term. Single-stock ETFs, while tempting with their high yields, are riskier due to their concentration. If MicroStrategy or NVIDIA tanks, MSTY or NVDY takes a hit. With indexes, if one stock falters, others balance it out. Take MSTY as an example. It's tied to MicroStrategy, which is a leveraged play on Bitcoin. If you're bullish on Bitcoin going to $1 million, MSTY might seem like a no-brainer. But understanding MicroStrategy requires deep research into its business model, debt structure, and Bitcoin holdings, more than I have time for. Index ETFs let me capture market growth without betting on one company. My portfolio's 20% plus gains, plus 16.42% yield, prove I'm not missing out. I sleep soundly knowing I'm diversified, and my conviction in this strategy outweighs the allure of chasing high-flying single-stock funds. Thoughts on YieldMax ETFs? Speaking of single-stock ETFs, let's talk about YieldMax and funds like MSTY and ULTY. I made a video titled, Why I Don't Invest in MSTY and ULTY, and here's the scoop. First, on MSTY and Bitcoin, I take a Warren Buffett approach. Bitcoin doesn't produce anything tangible, like a farm or a factory. It relies on someone else being more excited to buy it than you were. That said, learning about Bitcoin opened my eyes to the history of money, which is fascinating. It made me see why Bitcoin exists and why some advocate for it as a currency standard. I'm warming up to it. Adoption is growing and it's more stable than before, but I don't own Bitcoin or MSTY yet. I might allocate a small portion in the future, but I'm still researching to ensure it fits my strategy. As for ULTY and YieldMax's high-yield funds, I don't think they're a scam. Far from it. YieldMax is transparent about its mission: maximize yields and distributions. I've interviewed Jay Pestricelli, and his message is consistent. They're delivering exactly what they promise. But their funds, with yields often 50 to 100%, are more suited for specific scenarios, like retirement or short-term income needs. For example, someone might use YieldMax to replace the 4% rule in retirement, selling off 4% of their portfolio annually. Or maybe they're between jobs and need a yield boost. These are tactical plays, not 30-40-year wealth-building strategies. At 35, I'm in the accumulation phase, focused on compounding wealth. YieldMax funds cap upside due to their covered call strategies, capturing more downside than growth. For someone my age, that's less appealing than index-based ETFs, which balance yield and price appreciation. If you're 24 or 35 like our host and me, you're likely prioritizing growth. In retirement, YieldMax's high yields could be perfect. But for now, I'm sticking with funds that offer both income and upside. NAV erosion and high-yield funds. A big concern with high-yield funds like YieldMax or Granite Shares Yield Boost products is NAV erosion, the decline in net asset value. NAV is calculated by dividing a fund's assets under management by its outstanding units. Cover call ETFs cap upside because they sell call options, limiting gains when stocks soar. But the downside? It's like a black hole. There's no floor. If the underlying stocks drop, the NAV follows, and big distributions can further reduce it. My portfolio avoids NAV erosion because I focus on index-based ETFs with stable distributions and price appreciation. On Blossom, my portfolio's up 20% plus, not counting distributions, which have grown month over month. Compare that to funds like ULTY or Granite Shares products, where share prices often trend downward due to high distributions and capped upside. I've chatted with Will Ryan from Granite Shares, and he's up front. Their yield boost products, built on daily leverage ETFs, are better for short-term trading or dividend capture, not buy-and-hold strategies like mine. YieldMax funds can be held longer term, but they're still riskier for buy-and-hold investors due to potential NAV declines. For example, if you buy a YieldMax fund and the market crashes, your distributions might shrink alongside the NAV. My index-based ETFs, tied to the broader economy, are more resilient, recovering even after events like Liberation Day's correction. My portfolio's at all-time highs, proving diversification works, weathering a recession. What about a stock market crash or recession? Critics love to say cover call investors will get destroyed in a downturn. I disagree. We got a taste of volatility with Liberation Day's correction, a 5 to 10% drop, typical for markets. My portfolio barely flinched. Why? Diversification across indexes means I'm not tied to one stock or sector. Even with my small energy position down, everything else hit all-time highs. I reinvest distributions immediately, compounding my returns, and my strategy's built to weather storms. In a full-blown crash, I'd stick to my plan. Keep buying index-based ETFs and reinvesting distributions. I believe the market will recover. It always has. If you think it won't, maybe guns and coffee is your investment strategy. But for me, there's no hesitation. My portfolio's risk level is about a 2 out of 5. Cover call ETFs reduce volatility slightly, and indexes spread risk across the economy. I'm confident it'll ride out any storm, and I'll stay hands-off, maybe tweaking to capture extra upside if opportunities arise. Financial independence by 45. My goal is to achieve financial independence by 45. Not the earliest, but the latest, tied to when my sons graduate high school. My oldest graduates when I'm 44, the youngest at 46. I want to be there for them, maybe guiding them into a trade like mine if they're unsure of their path. By 45, I aim for a $2 million portfolio, generating around $40,000 a month in distributions. Yes, a month. That's ambitious, but I'm planning to reinvest 30 to 50% of my distributions to keep compounding, protecting against economic shocks or lower yields. My strategy balances yield and growth, so my yield on cost could grow over decades, potentially outpacing even YieldMax's high yields. For example, If I buy a fund at $10 and it pays $1 in distributions, as those distributions rise with market growth, my yield on cost could hit 100%. It's a long game, but it gives me more chances to compound daily, unlike high-yield funds that front-load returns but risk downside. Weekly versus monthly distributions. Do I prefer weekly or monthly distributions? I'm fine with monthly. It gives fund managers more time to collect premium, potentially boosting yields. Weekly payouts are great for cash flow, but monthly aligns with my hands-off approach. Either way, I reinvest distributions immediately, maximizing compounding. My 16.42% yield feels low compared to 50 to 100% funds, but it's sustainable, with no erosion and consistent growth. I'm not chasing exotic yields. I want the best of both worlds, income and upside. Is cover call investing underrated? Is cover call ETF investing underrated or overrated? I'd say underrated, especially if you've only read vague critiques online. Some articles dismiss high yields as risky, but they miss the deeper value. Cover call ETFs aren't just an investment strategy, they're a lifestyle strategy. They let me build passive income while working a demanding job and raising a family. The 10 to 16% yields, like those from MSTY or SPII, are now seen as routine, but they're powerful when paired with price appreciation. You're not just waiting for a monthly payout, you're compounding daily, capturing market upside. Tips for beginners first: listen to diverse voices, YouTube, podcasts, books. I was inspired by index-focused investors like Graham Stephan, Andre Geek, Brandon Beavis, and Adrian from Canadian in a t-shirt. They share a core strategy: passive index-based investing. Start with an S&P 500 or NASDAQ 100 ETF, with or without a cover call strategy, to get your money working while you learn. Don't just copy social media portfolios. Build one that suits your goals. Second, keep it simple. If you're busy like me, index-based ETFs are low maintenance and diversified. You don't need to master balance sheets or pick the next Tesla. Let the market's growth do the heavy lifting. Third, reinvest distributions to compound your returns. My portfolio grows because I pour every distribution back in, amplifying my wealth over time. Want to follow my journey? Check out my YouTube channel, Cover Call ETF Investing, where I post weekly videos every Sunday at 9 a.m. I share portfolio updates, performance against indexes, and transparent insights into my strategy. With time constraints, one video a week keeps it manageable, but I'm passionate about helping others learn. You can also see my 90-week post history on Blossom, showing my portfolio's growth, distributions, and highs and lows. I'm also proud of my Cover Call ETF All-Star Tracker, a Google sheet covering 300 funds across Canada and the US. It's got live performance data, forward-looking yields, AUM, and more, updated monthly for just $50 a year. Whether you're researching taxes, yields, or fund comparisons, it's a one-stop shop for eureka moments. I pour hours into it, ensuring it's a valuable tool for investors. No compensation here, just a genuine recommendation to check it out.